When we talked 5 years ago, you said we're software guys making hardware.
When we started, I don't think we thought about the challenges that we would encounter. We just went ahead and did it. My co-founder Eric and I are really software guys. We have never done hardware.
Now, 5 years later, CEO James Park is sticking to that claim, even though it's the company's hardware that's made Fitbit a household name.
I mean, 2/3 are engineers, software engineers versus hardware engineers. But it's really about the combination of the two working well together that create the magic. So I don't know. I don't think we can classify ourselves as strictly a hardware company or a software company.
Hypergrowth might be a hard thing to manage, but growing sales more slowly can be just as difficult.
We had a rocket ship of a company for quite a long time. I mean, as you pointed out, we shipped our first product in 2009, shipped about 5,000 units, and then last year we shipped over 20 million. So it's been pretty stratospheric growth, and now the challenge is we're moving into a slightly different environment. So it's a new set of issues that myself and the company has to tackle.
Which are what?
Moving from an environment where it's hypergrowth to one where I think we have to be more efficient and focus on fixing a lot of the things that we had kind of ignored in the past just because of our growth profile. But I think that's a good thing for the company. It's time for us to kind of reflect, look at the things that are working, not working, make the right fixes, and then chart a path back to growth.
Fitbit's first ever contraction has been painful to employees and to Wall Street. Since the company's IPO back in 2015, Fit shares have plummeted over 71%.
Are you glad you did the offering? So many companies have stayed private for longer periods of time, and I wonder, in retrospect, if you look back to the IPO, whether that was something that were the negatives outweigh the positives.
There's always positives and negatives to a lot of these decisions. The positives for us is that for the longest time, we weren't very well capitalized as a company. We had hyper growth, but our balance sheet was always pretty light. So we always viewed the IPO primarily as a financing event. And when we went public, we raised hundreds of millions of dollars, and it was the largest consumer electronics IPO in US history. So that was a huge event, put a lot of cash on our balance sheet. I think at the end of December, we had approximately $700 million in cash. And so that gives, I think, a lot of confidence for us to operate the business going forward.
Working capital and
working capital,
R&D.
sleep at night money, R&D, M&A, all those things. It gives a lot of flexibility and security to the business.
When you look at the stock price, and I'm not, stock price is stock price, right? But I wonder what that means for you in terms of sort of the business plan and keeping the high margins that you've kept and other decisions that you've made there. You could certainly goose earnings, or goose sales, I would think, if you lowered prices and cut margins, but you've chosen not to do that. Why is that?
Pricing is something that you can't, reverse from. So, we want to make sure that people really value our products. And I think maintaining pricing discipline is an important part of that. And we do invest a lot in pretty significant and innovative and original research and development, and that's something that we want to continue. The stock price and the public investors, that's all very important considerations into how we run the business, but it's also one input. I think what shareholders would like us to see is to properly manage some of the short-term interests, but also look at the long term. And I hope that we're able to do that as a business.
Fading customer demand caused Fitbit's fourth quarter revenue to fall by 19%. Fitbit announcing a restructuring plan, taking a $4 million charge and laying off 110 employees. So how does Fitbit plan to turn it around?
We're going to streamline our product portfolio. Right now we have just way too many trackers that are out there. And then more importantly, a real focus on software, coaching, guidance, personalization, because the later adopters in this category really want solutions rather than just data and tracking. And then, we want to move into adjacencies like smartwatches. The acquisitions of Pebble, Vector, and Coin all play into that strategy. We've already announced that we're entering that category, and it's a move that will immediately double our addressable market. So that's a huge area of growth. Not only that, I kind of hinted that there's form factors beyond the wrist that we're looking at as well. And then as part of our restructuring and a reorg, we're looking at the business in two perspectives. One, consumer, but more importantly, what we call enterprise health as well, where we want to target, we've already targeted employers, but starting to target in a more focused way insurers and other partners in the healthcare ecosystem.
And the opportunity for you to write move 100,000 units at a time.
There will be incredible opportunity for bulk recurring sales tied to health plans.
Ultimately, it comes down to inspiring sales and getting customers on their feet.
What do you wish someone could have told you, 5-year-old younger or 5-year younger you?
There's a lot of challenges today that would have been a lot easier to manage as a private company. Just because you're less visible, you're not being judged on a day-to-day basis.
Right.
And so a lot of the things you have to do to chart a path back to growth and profitability are, definitely a lot harder in the public spotlight. And what I think about on a daily basis is how we transform Fitbit into a product that's kind of a nice to have into something that's a must have. And a lot of that is going to come into how we integrate more effectively into the healthcare ecosystem.